Hello, everyone, and welcome to the Hardcore Finance Show with Shimon and Alex. And today we're recording. This will be a little bit lagged as we probably post this the week of May, somewhere around May, maybe 11th or 12th. But today's May 5th, and the markets. This will be the 5th of Cinco de Mayo. Is a bloody Cinco de Mayo
massacre.
Cinco de Mayo at Coinbase down 12%, NASDAQ down 5%, QLD down 10%. Let's see some other big winners. S&P down 3.5%. Amazon, why? I don't know why. Down 7.5%. Microsoft, who beat earnings and upped revenue projections, is down 5%. NVIDIA, the kingmaker of all chips, who outperforms every single quarter, down 7%. Apple down 6%. Yeah, Shimon, what the hell?
Yeah, I think basically now the Fed is trying to signal to the market that they're being serious about tightening a little bit the interest rates. They're really afraid about inflation because they have midterms coming up. And so inflation is something that everybody feels. So they really want to deflate the market a little bit. But the problem is, what I think they're not anticipating is that first of all, they cannot increase rates by too much because they have so much debt. Second of all, you know what's worse than inflation? A recession, where you actually lose your job, right? Like, it's one thing to have a job, and, some of our friends have experienced this, which is like, you got a 5% raise, which is basically you're getting less money year over year, given the inflation. So that's tough. But what's tougher is like not having a job. So I think what my prediction is that this is a short-term thing, and the markets will crash, but then they will overcorrect to the other direction. That's what I'm thinking. But what are you thinking?
Well, so I agree. I have a slightly different take. I think the Fed has been way behind. People were talking about it. Mohammed, what's his name? Mohammed
El-Arian?
Huh?
Mohammed El-Arian?
El-Arian, yes. Mohammed El-Arian, I love him. He's a fantastic economist. He's been talking about it to his credit for like 9 months. And because the Fed is so behind, I think the markets are just taking it, in their own hands. Now, yesterday, the markets pumped. Why? Because the Fed Powell came out and said, hey, 75 basis point interest hike is off the table, right? So I think that really helped. But today, I think it's just a very technically driven market, technical analysis. I know you and I talked about this before. You don't like it. I love it. This is why. There's no fundamentals of Microsoft or Amazon have changed. Microsoft, again, increased their guidance. Why are they down 5%? Nothing has changed. It's completely technically driven, pension fund driven market. And I'm hoping we're close to capitulation because today's bloodbath. Why the hell did it happen? Yesterday was a pump, and it was just like people are waiting for some sort of pump to get out. You know what I mean? Just to get out at all costs. This is a getting out at all costs type of scenario, which is very painful. But hopefully we're at the bottom, maybe another 10-15%, and then let's call it a day, guys. Let's call it a day. Definitely a bear market, but let's find some structure now.
Well, I have a different perspective on this just because it's longer term. So I wanted to share my screen here and show our viewers something pretty cool. Let's see here. This is the first time I'm sharing a screen on.
Share that. Oh man. This is the interactive podcast for all those viewers or listeners that are listening to us and are watching us. Shimon is still attempting to share a screen. I'm still attempting to stall in some sort of memorable way. It's not happening very well.
There we go.
The screen should come up.
All right.
Okay,
so this is the NASDAQ, and this is a NASDAQ since 2010. And the NASDAQ, the thing is, it is bubbly, right? So like if you guys look here, this is the 2000.com we crashed from 109. This is QQQ. It's
Just
an ETF.
explain the chart for those people listening and not watching.
Yeah, so this is QQQ, a chart that tracks the NASDAQ, ETF that tracks the NASDAQ. And basically, you can see here the dot-com bubble that burst like crazy. So we went from 111 to 20. So it was like more than an 80% crash. And then we had here another, this was the 2008, great financial crisis. But since then, I just drew a simple line here. And I believe that this line is the actual combination of technological growth plus money printing. And as we can see, it's not super stable, but it is we've never been below this line for very long. If we just ignore these external shocks, which is like, the dot-com bubble is the first time that dot-com stocks started IPOing. People didn't know how to value them. And the 2008 great financial crisis was problems in how people were getting mortgages and the credit in the system. But like if we ignore these two external events to the tech market and we just look at the tech market, you can see this red line just shows you technology is getting better and better, and also more and more money is being printed. So first of all, what I wanted to show is that even though the drop here was very big, like from 402 to like 315, and even though we went back to prices not seen since 2020, so we went back a lot, but we are still above the line. And that was my point. My point is like, I think what the Fed is trying to do is to kind of get everything back to normal in terms of this line. And that's why I'm thinking we don't have too much more room to drop. To your point, you call it capitulation, which is a technical term, but I'm just saying the line here is we're at 313 and the line is at 294 or whatever. So we don't have a lot more to go down. And I still think that it's a very good long-term investment. But what do you think, Alex? Will they be able to, what do you think about this interpretation?
Look, it's an interesting interpretation. Ironically, if you actually go back to the chart for a second and you extend, I don't know, can you draw on this chart?
Yeah.
If you extend the run rate, humor me, do a trend extension of pre-2008. So if you zoom out a little bit, yep, see that, yeah, draw the line on the pre-2008 slope. We'll be right on trend.
So just to continue?
No. Do it off of the 2002 through 2008. Yep, that one right there. But just draw do it to the slope.
Like this?
Yeah. So we are probably a little bit off, but we are actually trying to hit that old trend that we were setting, right? Before that. So if we go down a little bit more, we would be on trend. Now, what you talked about is that this includes money printing after 2008. So the slope naturally should be a little bit higher.
Exactly. So, the difference between these two slopes of this line, the red line, and then another line here, if I draw another line. Oops. As you can see, I'm not a huge charts person.
Yeah, you're cheating a little bit with your red line right now.
Yeah, if I draw another line here, let's say we
draw it off the tops or off the bottoms.
Yeah, it doesn't matter if it's tops or bottoms, but my point is that the red slope is higher than the green slope, which basically shows that something happened since 2009 that wasn't happening before, and that's the money printing, right? So, yeah. So that's I don't think we should be afraid of this drop. And again, if the thesis, I'm not a good trader. Like, I don't know how to trade the short term market, but I really think, I'm listening to all of these tech podcasts, and so many tech things are coming online. So as long as you don't get a margin call, I think we're okay. But what do you think about the interest rates? Do you think they'll be able to raise them and actually curb inflation and basically land this plane? I mean, I heard on a podcast that it's like landing a plane. It's like you don't want to go too down, you don't want to keep it too up. So the idea is like you want to kind of slowly increase the interest rates.
Yeah.
But then how are you the debt?
I don't think they'll be able to land the plane.
the whole idea of interest rates, if I take a little theoretical deep dive, because as you know, one of my favorite courses in my MBA program was money markets and the Fed, which basically explained the bowels of how the Fed works. So the idea is like that. You have a natural rate of interest, which is a theoretical concept of basically, on average, if you take the whole economy, how much are people willing to delay spending in order to receive, how much do they have to receive in order to buy something next year versus this year, right? All else equal. That's like the natural rate of interest. And overall, Thomas Piketty has a really good book about that called Capital in the 21st Century, where he looked at interest rates like hundreds and hundreds of years back. It's always around 5%, like real interest rate. Always, always, always. And then what you can do is like you can have more risky investments. Like he literally tells you, if you were like a European, wealthy person, you could invest in America and then get like 10%, but then you had a chance of like a war or something, like people taking your land, right? Or you could invest in Europe where everything was more stable and then you get 5%. Now, back then everything was in gold terms, so the money printing wasn't an issue. So think of the natural rate of interest as a theoretical concept. Just like they have natural unemployment rate, which is like people change jobs, people retrain, people take time to find jobs. So even like if everything's humming along, you have like a 2-3% whatever natural rate of unemployment. Anything above that is a problem, and anything below that, like the economy is overheating. So it's the same with interest rates. Like you have some kind of natural rate. Now, the central bank, what they can do is they can manipulate this rate, and they can just arbitrarily set it by printing money and buying treasuries. So do is the theory says when you have a recession, cut back on the interest, right? Then people will not hold the money, they will spend it because nothing pays them interest. And that kind of stimulates the economy, right? And when you have a surplus, when you have like really, really good economic growth, like we had with Trump, for example, you're supposed to increase the interest rate that the Fed pays. Think of the interest rate as like some kind of like, let's say you have wheat, you're generating wheat. It's like, how much of this wheat are you storing in a storehouse versus distributing to people? Lowering the interest rate means like open the barns and distribute the storage to people. Increasing the interest rate is like take more taxes or collect more wheat from the people, put it in storage. That's if everything operates perfectly. But the problem is the temptation to not operate perfectly is very big. Like, for example, Trump, right? He wanted to get reelected. So like he knew that if he increased the interest rates, it would hurt the stock market. It would hurt growth. And so he didn't increase the interest rates, even though the economy was doing really well. And so now we're paying for like his mistakes. And Biden, of course, did even worse in terms of just spending tons of money on infrastructure when we were still recovering from COVID. Like it was such a bad, and we spoke a lot about this, which is like, when the central government controls, when do you spend? It's not even do you do it in infrastructure? The question is, do you do it now or do you do it in 2023? Right? But they really wanted to push it through. So now with the conundrum, we have a very, very low interest rate, which means you have no grain stored in the barn, right? But you also have inflation because of all the, projects that the government did and COVID and all of these things. And the only way to reduce inflation is to take the grain. What is inflation? It's like too much grain everywhere. So like the only way is you got to take grain back from the people. I don't think they can do it. I really don't think that they can theoretically increase the interest rates right now, because like everything is kind of interconnected. And like if they increase it to like 5%, 6%, what you had these interest rates in the 90s, everything would collapse. Literally, people would default on their mortgages. Their houses will be underwater. The monthly payment of your mortgage will be like so high that you can't afford it. People will lose their jobs. So all of that, I think, is because we're manipulating this thing and not letting the natural interest rate be the interest rate that is set. And so I think that's kind of the conundrum that the government has. It's like either you have to pay for it by like, or another way to think about it, and then I want to hear what you think. We wanted to spend all these $1 trillion on COVID and infrastructure. There's only two ways to pay for them. Either you pay for them through inflation, or you pay for them through not doing other stuff, right? Uh, Basically, like that would be like to increase taxes, for example, to
Hmm.
get the money to pay. And they clearly have chosen the inflation path because I think in the midterms they will get slaughtered even more if they increase interest rates and there's like a crazy, unemployment and like real problems that are not just like, hey, food is a little bit more expensive, but like, riots on the streets. And like the US is the best economy currently in the world, from the big economies. And so I don't even want to think about other countries. Other countries are in the same conundrum because everybody's printing money at the same time. So I really don't think that they'll be able to increase interest rates. But, there's a big debate right now in financial Twitter. And so what do you think?
Why? What are people saying that they can? The people that are in the can raise rates camp. What are they saying?
Well, I mean, they just say you can raise rates, right? And then in order to pay for your debt, you just like print even more money. I actually don't know. I don't know how, because like the issue with debt is that you have debt that's maturing and you have to roll it over, right? So you have to roll it over at higher interest rates because the interest rates, what our listeners should understand, all the interest rates are connected because like there's arbitrage opportunities and so forth. So there's the Fed funds rate, which is like technically completely risk free because the Fed can print money. Then there's the government bonds rate, which is a little bit more risky because theoretically the government could just default on the debt, but like realistically it's not going to happen in the US. Then you have like debt that's like corporate debt, which is linked to like the growth of the economy and stuff. Then you have like more risky debts like mortgages, student loans, whatever, like, and credit cards are probably the most risky, and payday loans are even more. So like think of the risk curve of debt as like all connected, right? And so I think people will just not be able to, the governments won't be able to roll over their bonds unless they just print money, and then you can do it. Then it's like, okay, great. Like you want to charge us 5%. So now our interest expenses are like crazy, 30% of our GDP. No problem. We'll just print dollars. And then that creates even more inflation. So,
Yeah, the problem is that we can get into stagflation because of this. Stagflation is basically inflation and no growth, which is the worst economic. It's like the, bottom left corner of your 2x2. It's not up and to the right, it's bottom to the left. That's a problem. I don't think they can raise rates either. That's a very interesting point that you said about, well, one, they can't raise rates because our debt service, just the interest payment, is going to be a third of our annual budget, which is insane. Two, it's a very interesting point of looking at secondary, tertiary effects of that it's going to roll down and everyone's going to, people won't be able to pay back loans, credit cards, and so on and so forth. But you're going to have the left coming out, like Bernie and Elizabeth Warren is saying, oh, we have inflation because the big corporations are just, stealing from the poor and they're passing on costs, which is just, it's a whole separate topic that we should talk about.
mm-hmm.
I don't know. I don't think they can raise rates either. I think what's going to happen is we went 50 basis points now. We're going to come and get our hearings from our inflation hearings or numbers, CPI numbers, and hopefully March has peaked. Hopefully, right? And April is lower than March. Then we're going to come in and we're going to do 50 basis points in June, look at May's numbers, and hopefully that's peaked. Because if we start getting some relief from supply chains in general, then it's gonna be huge. The other thing is people bought a whole bunch of goods, and there was a lot of inflation for goods. Then all these manufacturers went and stocked up on goods. Now they're all sitting in inventory. Kathy Woods, our credit, has been talking about it for a half a year, and now other people are starting to pick up on it. She's a half a year ahead of everyone else. We have a big inventory issue. And once it hits and you're like, oh shoot, the inventory is sitting there and not being able to be used, those prices start collapsing. But now we have an inflation in services, right? Everyone wants to travel. Everyone wants to go out and experience because they've been stuck at home. That's all going to die down in, let's say, 6 months. We're like, okay, enough travel. We got, So at some point towards the end of the year, I hope that the strain on the supply chain, plus naturally catching up, will bait, right? Just gonna be very painful half a year. The only last bastion that hasn't really fallen, I'm sorry to say, I mean, I don't wish this on anyone. I don't wish this on you, but it's real estate, right? Real estate is the only one that hasn't really taken a hit. Stocks have taken a hit, almost ahead of the Fed, right? The market, the bond market, priced down stocks. Real estate, however, is still holding pretty strong, and at some point that has to give. When there's capitulation in real estate, then I think we've hit a bottom.
Yeah, I mean, it's interesting because I think tech is the only thing that can get us out of this mess. Not tech in terms of stocks, but tech in terms of technology. Like we spoke about the commodities thing in the previous episode, where, growing wheat is a problem that humanity has solved. It just takes time. Somebody I heard another podcast on the war in Ukraine, and they basically said even if the government decides to spend infinite money on producing Javelin missiles, they cannot increase the production of Javelin missiles within the next 1 year. 1 year from now, they can have an arbitrary amount. They can have 3 times the amount of missiles, 10 times the amount of missiles, no problem. But within 1 year, because it takes a very long time to build these production lines. So my point is, if tech helps with food prices, I mean, food is basically land plus energy plus labor, right? Like the energy goes in the fertilizers. The land is because you actually need like places to grow the food, and then labor because you need to actually weed it and collect it. So tech could theoretically solve all of these issues, right? Land, you can solve it with self-driving trucks, where suddenly you have trucks that transport stuff from far away where land is cheap. Energy, we spoke about it so many times. It's hard to solve, but we know the solution: build nuclear power plants. So it's like we have the solutions for all of these things. The question is like, how long would it take? It could be a rough couple of years where it's hard to kind of restart those things. But then I really think that also with the war in Ukraine, there's a lot of positive things. Like I heard now many countries are investing in nuclear energy because they understand that's the only way to get off the Russian gas. So I think that this correction is actually healthy. I know it sucks. I know it's painful, but I think it will spur technological innovation to reduce inflation. But again, it can get really ugly if the government starts monetizing the debt. By the way, what I mentioned before, which is like paying the interest rate with printed money, it's called monetizing the debt, and it's what destroys your currency. That's like Latin American countries have been doing this forever. So once you start printing money to pay for your debt, then your interest has to increase even more.
Which is what we've been doing.
Exactly. So it could go really wrong. I just think sometimes I want to look at humanity not from a financial perspective, but from an actual moving atoms from place to place perspective, right? And housing is also interesting because housing, it's not expensive to build a house. What's expensive is like the land and the labor and getting the building materials to the place where they need to be. But like, if I were to just build a house in the middle of nowhere and I had like the plant that makes all the materials next to that place, it's super cheap to build a house. So real estate, I don't know. I mean, it's a good question what will happen to real estate. I really don't know. What do you think? Do you think that real estate will actually...
No, I think there'll be some sort of capitulation in real estate, for sure. I mean, look, the fact that the Fed was buying mortgage-backed securities, well into this year, that in itself propped the housing market. It was up 20% already, and they were buying mortgage-backed securities still. Like, why? It was total just injection of cash into the market, and I mean, after COVID, you remember people moved, but the values went up 25, 20, 25, 30%. That's crazy talk. Unleveraged investments. So, a house goes up by 20% and you have 20% down, right? That's 100% for you. That's an increase of 100%, which is just insane, So I think something is going to come out of the market for sure. Yeah, you just can't keep up with the way it is.
But do you think technology will get us out of this, or do you think we're...
Yeah, but in the long run, I think in next year, hopefully not longer, but next year is going to be brutal. This year has already been brutal. It's been definitely tough going, but You think technology is going to act in this year? You think it's going to save us now?
I really don't know about timescales. It's really hard for me to say anything about timescales. When I look at the trend line, it seems that we're right on the trend line currently. So, like, as long as we don't go a lot lower than this, we can just keep chugging along by
Yeah,
technological innovation. I mean, it's
yeah.
just like another thing is like when they asked, I think some politician like, have you seen the price of gas recently? And he's like, no, because I drive an electric car. It's like, yeah, theoretically, if everybody,
Heavy is the crown. Let's like let them eat cake. It's a
yeah,
Marie Antoinette kind of answer.
exactly. So I don't know, but I mean, I'm optimistic in the sense that even if you look at like 1929, again, if you didn't get a margin call and you just held through all the craziness, the stock market still gave you really good returns.
Yeah.
So
On
that's that's what I'm hoping.
on this optimistic note, Shimon says, "Buy the red, buy the blood, stay in the market
Well, I
from a
mean,
long-term horizon."
it's all about do you have use for the money? And by the way, another thing is like, do you keep some cash in order to rebalance? Like that's one thing that we haven't spoken about. We are usually talking about leverage, which is having negative cash. But like if we had cash right now, it would have been great because then we could buy the Nasdaq at a huge discount. So that's another thing. Like holding a certain percentage of the portfolio in cash, I'm starting to think that it might not be a very bad idea.
Yeah, for sure. Have some dry powder to pull triggers. We should discuss this next time. What percentage of the portfolio should be in cash? Let's actually take a back of the envelope, a rigorous approach to it. Opportunity cost and what the market conditions must be, right? Like to say, hey, I'm in cash so I can buy, right, on dips. But then again, I'm missing out on this appreciation, right?
Yeah, and
The
our
cash not being an
portfolios
asset.
did grow a lot because we didn't hold cash. I mean, our portfolio like 2 years ago was much lower than today. So overall, this strategy is working. It just sucks in the short term.
Sucks in the short term. Stay in the markets. Leave us comments. Suggest topics.
Yeah, we would
Rate
like
us.
to know what our listeners think about technology. Would technology be able to deliver the economic growth that we're expecting to get us out of this mess, or will we pay for it through inflation, or will we have a
We will pay
deflation because
for it.
of the crash of prices? Those are like the three options. Like prices hold steady, prices go up, prices go down. We want to know what you think.
Love it. All right, Shimon. Until next time.
Alrighty, thank you, Alex. Thanks, everybody, and see you next time.